Good afternoon and welcome to the Smart Women Savvy Money 2010 webinar series. 30 minutes on the clock, 20 minutes to teach, and 10 to talk. This is Renee Norris, Managing Director of Urban Wealth Management, and this webinar series is one of several educational outreach programs offered through our Smart Women Club, where women are encouraged to learn, explore, and feel confident about making sound financial decisions. Our vision is that every woman designs the lifestyle she desires and deserves. Our webinars are hosted on the second Thursday of each month from 1 to 1:30 p.m. Pacific time, except for December. December's holidays, and we know you guys are really super busy. The great thing is, if you can't make it, not to worry, because all of our calls are recorded and available for replay at any time. Just be sure to register for the call, and we'll be sure to send you the link. We've got a great lineup of speakers and events, which you can find on our website here. This past January, for example, January 21st, as a matter of fact, we hosted our first full-day women's conference, New Year, New You. And as it turns out, even though we had been planning this well over 6 months, it was the same day as the National Women's March. But it was an outstanding day with lots of great inspirational speakers, and everyone walked away with actionable ideas and steps. We actually have a whole host of great information and content for you as well, and you can find out what upcoming events that we have. Next month, for example, we're going to have a great conversation around behavioral finance issues, psychological issues. Does fear get in the way of your money mojo? We have 2 great speakers, one of whom is a money coach. The other person is a therapist. So they will be doing a deep dive into what are some of the things that are challenging and preventing you from wanting to manage your finances. And as we dig deep into that, we oftentimes find out that there's some issues that happened earlier in our lives. Isn't that always the case? In April, we've got 2 events happening. In April, we're going to have our Tech Diva back, Zenobia Millett, who's going to talk about how to hack-proof your life. Now, you can't do 100% hack-proof, but I'm sure we all hear every day about businesses whose systems have been hacked. Well, as individuals, we typically have problems with our emails being hacked or even our social media pages. So she's going to discuss some common sense ways to get around that, and that things that you can incorporate on a daily basis. Also in April, we will have a series starting April 19th, a series of educational sessions on investing. We always get that response and request, actually. I need to understand more about investing, the difference between a stock and a bond and a mutual fund and an ETF. Well, we're going to do that in a 5-part series, whether you're an ingenue, so it's going to be great for younger people just kind of getting into this whole capital markets idea, as well as for many of us who might just need a refresher. That will begin April 19th, so you'll be able to come back here to the site and be able to register. Now, before we get into our actual presentation today, I'd like to just cover a few housekeeping items. As I mentioned, the call is being recorded, and we will be sending you the replay link within a few hours after the call actually is ended today. Also, if you have any questions, there is a chat box. Feel free to send a question, and I'm sure many of us will have some questions as we go through the presentation today. And we do like to stay on time. That's why we call it our 2010 series. And we will be able to, if we're not able to cover everything in the 30 minutes that we've set aside, we're more than welcome to continue the conversation afterwards. Just let us know, and I'll put you in contact directly with our presenter. And I am going to now turn over the presentation to our presenter, who is Ms. Janice Cohen. And Janice has been in this particular arena for quite some time and is considered an expert. So we're looking forward to having her to talk more about this space. And there have been a number of changes that have taken place over the years, and she can actually speak to what some of those updates and changes have been. And in just a minute, I will turn that over to Janice. Janice, are you there? Are you on the call? Okay, well, let's give it a minute. And
hi, Renee.
There you are. Hello there,
Hi.
Janice. Welcome. Thank you for joining us today. We have quite a few people who have some interest in this subject, so I am going to turn this over to you so that you can do a deeper dive.
Okay, perfect. I had a little technical problem. I don't know if you were trying to get me on earlier. I'm sorry, but I'm here now, so that's good.
You're here now. That's what counts.
Yes. So I want to thank you, Renee, for the opportunity to talk a little bit about reverse mortgages. I've been a reverse mortgage advisor for 12 years, and as I tell people, I was a teacher in my previous life, and what I tell people is that the only thing I knew about mortgages was when I took this job was that I had one. And I have certainly learned a lot over the past 12 years, and particularly specializing in reverse mortgages, and every year learning more and more about how a reverse mortgage can change a person's life, and how more and more people who want to live life on their terms are utilizing the reverse mortgage to have a safer, happier, healthier retirement. So one of the things that people ask me a lot is, you know, I've heard some things about reverse mortgages that are not good, and I really want to, you know, find out why am I hearing these things, and is a reverse mortgage a good thing and a bad thing, or a bad thing? And I'm going to give you what I think are the good, the bad, the ugly about reverse mortgages. And also, I want to give you a little bit of the history about reverse mortgages and why it is that reverse mortgages might have, you know, a stink on them, that, you know, that people hear from their hairdressers, brothers, uncles, nephews, college roommate, that it's not a good thing to do. Reverse mortgages began more as an insurance product. That was, there was an insurance company who was doing reverse mortgages in order to access equity to convert into an insurance product. And I should say from the outset, that is no longer allowed. Actually, that is, you know, against the regulations for a reverse mortgage. But that was how reverse mortgages began. And what ended up happening was that in the early 1980s, the FHA saw that this program was becoming popular and said, the principle of this is good, but we're seeing some things we don't like, and we're going to insure this program. We're going to regulate this program. And here are some of the things that I've seen change over the years. Years ago, if a person were married and to a younger individual and wanted to do the reverse mortgage on their home, their spouse, upon the death of the borrower, would have to sell the house within a year of the passing of their husband or wife. So now what we're seeing is that the regulations allow the spouse to remain in the home indefinitely. So the non-borrowing spouse now has lifetime rights to remain in the home. So that makes a huge difference for people, knowing that their spouse can, even if their spouse is not on title, not on the deed, if they're married, their spouse can stay in the home forever. Another thing that kind of gave the reverse mortgage a bad reputation was that the fees used to be very high. And again, FHA, Federal Housing Administration, did change this fee structure several years ago so that the fees have come down quite a bit. And the rates have also come down. Right now we're still dealing with historically low rates. And so that does also make this a much more attractive program. Historically, people have used the reverse mortgage in three ways that we'll talk about during this call. One was that they use the reverse mortgage as a last resort when they run out of money. When their financial advisor says to them, well, you just used up your last $100. What are you going to do now? That's when they would say, oh, I better take out a reverse mortgage. Number two, they might use it as a first option on the onset of retirement. And I have a little Excel spreadsheet that we'll get to shortly, and I will explain how that can be a really important approach. And then used in a coordinated strategy, using your income, your retirement assets, and your housing wealth in a coordinated strategy to maximize both. So yes, historically, were there some problems with the reverse mortgage? Absolutely. The whole industry has recognized that, and many years have passed since important changes were made, but there still are reputational issues with the reverse mortgage. But they're only reputational, not functional, because most of these issues have been addressed. So if we look at the difference between a reverse mortgage and a traditional mortgage, there are four factors that really define the reverse mortgage. And number one is age restriction. The reverse mortgage is only available to people over the age of 62. And if you are 62 and married to someone under the age of 62, you are still eligible for a reverse mortgage. At least one of the individuals on title has to be 62. Number two is repayment flexibility. Many people obviously all people who take out a traditional mortgage have to make payments on their mortgage. With a reverse mortgage, you have the choice. You can either make payments or you can defer payments. If you make payments, that would be a person who has decided they want to prevent their loan balance from growing, or they want to keep their loan balance as low as possible. And if they're deferring payments, it's because they're saying, well, we know the loan balance is going to grow because the interest is being folded in each month, but that's okay. We are getting the benefit of the reverse mortgage. We're having a better quality of life. Number three, the reverse mortgage is a non-recourse loan. It's insured by the Federal Housing Administration. Even if someone should live a very, very long life, having taken out all of the equity that they're eligible to get, and their home has decreased in value for whatever reason, if the house is underwater, the loan can be satisfied by simply selling the home. Whatever the home sells for will satisfy the mortgage. It will be considered paid in full because this is an insured non-recourse loan. And number four, the rising line of credit, which is my favorite aspect of this mortgage. And I think it's just a wonderful thing. And that is that when you open a reverse mortgage line of credit, as you age, every single year, the amount of money that you have available to you in that line of credit increases. So that as you age, you'll have more and more money available, and it's a terrific way to have increased security even as you age. So how much money can a person receive from their reverse mortgage? There are three factors that go into answering that question. Number one is the age of the youngest borrower. So I will tell you that whether a person is 62 or 90, if the interest rates are exactly as they are right now, the 62-year-old is going to be able to borrow about 50% of the value of their home, and the 92-year-old would be able to borrow maybe 75% of the value of their home. So how old you are does make a difference, but mostly that has to do with whether the interest rates are the same. If you're a younger person and the interest rate is lower, then you might be able to borrow more than if you were 10 years older and the rates were higher. So, so the value of the property, someone who has a home that's worth $200,000 might be looking at being able to borrow about $100,000. A person who has $600,000 home might be able to borrow about $300,000. And the interest rate. Right now, we still are in a period of historically low interest rates, and the interest rate, as I mentioned before, the lower the interest rate, the more money that you can borrow, and the higher the interest rate, the less money you can borrow. So it does cut into the proceeds when the rate goes up. So how can proceeds be received? Number one, and this is one of my favorite ways, is a line of credit. Someone who has no mortgage on their home can open up a line of credit. Let's say you have a home that's worth $600,000. You can open up a line of credit, let's say for $350,000, and you can take money only when you need it, and for whatever reason you need it. Let's say you want to buy a car. You can take out $30,000 and you can buy that car, or you need to put a new roof on your house. You could take out $7,000 from the line of credit and you can put a new roof. So there's no scheduled disbursement with the line of credit. Take the money when you need it. The number two way to take it would be a lump sum. Let's say you have a $350,000 mortgage that you're paying, and the reverse mortgage will allow you to borrow $350,000. That money is going to go toward paying off your existing mortgage, and you will then not have a line of credit, but you will not have to make payments on your mortgage anymore. You will, however, have to make payments on your taxes and your homeowner's insurance. Those two things do not go away, but you would not have to make mortgage payments anymore. Then there is the monthly tenure payments. Monthly tenure payments is monthly income for the rest of your life as long as you remain in your home. So let's say you're deciding on tenure payments and you've reached your 100th birthday, and then you have your birthday and you continue to live another 20 years. Let's say you live 120 years. You would continue to receive monthly income no matter how long you live. And you still may very well have a lot of equity left in your home that when you are no longer here, your heirs can sell your home and they can enjoy receiving whatever equity is left over. So monthly tenure payments means monthly income amortized over the course of your lifetime for the rest of your life, even if you live till age 120. Monthly term payments, that would be monthly income for either a defined period of time or for a defined amount. I have a client right now who is needing a lot of in-home health care. He has Parkinson's, and it's very advanced, and they have almost round-the-clock care. They need $7,000 a month. So they are needing $7,000 a month for as long as it's going to last, and based on our conversation, they will Whatever happens when that money stops being available, we will cross that bridge when we get there. But they need that $7,000 a month right now. I have other clients who've said, I really only plan to remain in my home another 10 years. So I want monthly income for 10 years. And at that point, I'm going to sell anyway. So I want a 10-year term, and I'm not going to worry about what's going to happen after. And then there's a combination. Some people want, a $100,000 line of credit, and they want to receive monthly 10-year income. Some people might want to pay off a $50,000 home equity line, and they want to have a monthly income of $2,500 a month. So it's a very, very flexible program, and we can really tailor it to meet the needs of anyone who has a specific need. So how does this loan get repaid, and when does the loan get repaid? The loan gets repaid when the last surviving borrower permanently departs the home. So that might be when they are deceased, or when they sell the house, or even if they have been in a nursing home or assisted living for over a year, and it does not make sense for them to ever return to the home. Of course, if a person is away for a protracted period of time, the lender and the servicer still makes the assumption that the family will continue to pay the taxes and the homeowner's insurance. But if that person is no longer able to remain in their home, at the time that the house is sold, it would be listed with a realtor, sold, and whatever proceeds were advanced to the borrower plus accrued interest and HUD fees will be repaid at the time of the sale. And 100% of the remaining equity is passed on to the borrower, the heirs, or the estate. So while in the 1970s there might have been lenders that were going on title with the borrowers, taking a portion of the equity, that is no longer the case, and now 100% of the equity is always passed on to the borrowers. So when we think of retirees, maybe we think of ourselves, maybe we think of our parents, maybe we think of neighbors, but the new face of retirement is this. And I can't say that a whole lot of my clients look like this, but more and more my clients are looking like this, because my clients are taking really good care of themselves, and they're giving themselves a good quality of life. They enjoy themselves. They socialize. They go out. They have friends. And they have a higher, I think, a higher level of enjoying life than a generation before. And so they are not the people who are saying, I want to sacrifice everything. They're the people who are saying, I feel good. I want to do fun things. I want to go on a vacation. I want to do all these things. I don't want to have to sacrifice. So more and more of them are doing reverse mortgages so that they can really live every day to the fullest, but of course to be responsible as well. And when we think about living responsibly, I can't even tell you how many people I know who I've done reverse mortgages for, who have said to me, and it's always with a little bit of sadness that I hear people say this, they'll say, I never thought I would do a reverse mortgage because I did everything right. I invested wisely, and I put money away, and I took care of my home. And I say to them, you did do everything right. But even for everyone who does things right and is smart and has advisors, what we do have experiences that are outside of our control. And these are risks to the quality of our retirement. And some of these risks include leading a very long and healthy life. It's great to live a long, long time, but of course, the longer we live, the better the chance that we're going to outlive our money, and that's the number one fear that people have. Number two is inflation risk. We don't know what's going to happen to the price of gas when we pull up to the gas tank. We don't know what's going to happen to the prices of fruits and vegetables when there's a drought in California, which hopefully is resolving itself now. You know, there might be excessive withdrawal from your bank account for whatever reason, whether it's to help a family member or the house has become a money pit or any number of things that make us have to keep going back to the well. Health expense risk. You break your ankle. I broke my ankle a year and a half ago. It came as quite a shock. I was really out of commission for 6 weeks. Health expense risk, you know, not just the loss of income during that period when you're recuperating, but also the loss of, you know, the expenditure of money. I was receiving bills from the hospital for x-rays and, you know, these, of course, thank God I had health insurance, but, you know, there are always co-pays. And then long-term care risk. If you do reach a point where you're still in your home and you need someone to come in, even if it's just to, you know, help with basic self-care duties during the course of the day, you know, long-term care is expensive. And hopefully you have long-term care insurance, but if not, I have had a lot of clients over the course of the years that have used the reverse mortgage in lieu of the long-term care insurance. You know, then there's the market risk. You know, we always hope that the market's going to just keep on going up, but we know that's not the case. There's always fluctuation in the market, so we may have periods where our money is down. Interest rate risk and liquidity risk, sequence of returns when we start our retirement. Do we have all of our money liquid? And is the cost of borrowing money reasonable, these interest rates? So these are all important potential obstacles to having a sense of security in retirement and to having that sense that even if you've done everything right, and we certainly hope that you are doing everything right, it doesn't necessarily mean that it doesn't pay to have a cushion. And I want to illustrate this side-by-side spreadsheet to show two approaches to your retirement. We have two individuals with identical situations. They both have $500,000 in assets. They're both retiring at the age of 65, and their retirement comes to an end at the age of 94. And what we're looking at in the first scenario on the left, this person is taking 5.5% of his assets, and he's giving himself a 3.5% increase each year. So he starts out with $27,500, and it's a down market year. If we look at historical investment performance, we see it's a down market year. The next year he takes $28,000 and change, and again, it was a down market year. The following year he takes $29,000, and it was an up market year. But he keeps taking until he runs out of money, and then he does the reverse mortgage. That is one approach, and if you'll notice, if we look at the column right next to the color-coded column that says amount in portfolio at end of year, at the end of this person's life, he has nothing left in his portfolio. If you look over to the right-hand side, we have the identical scenario, $500,000 in a portfolio. And this person, however, has done something very wise. He has taken a line of credit. We talked about the reverse mortgage line of credit and how you would just leave it there even if you don't need it. So this person has taken that line of credit and he's using what we're calling a coordinated strategy, where instead of just blowing through all his money until he's out of it, he makes the decision with his advisor to, in the year following a down market, he's going to leave his assets in place, and instead of drawing from his portfolio, he's going to utilize income from the line of credit in the form of monthly income to match what he would have taken had he just continued to take from his portfolio. This person on the right-hand side does this strategy, employs this strategy a total of 7 times in years 74, 75, each year following a down market. And in the end, this person has borrowed money, certainly, from the reverse mortgage. But if you look and see what when he passed away at 94, how much he had left in his portfolio, he had over $1 million, having started with $500,000. So when people tell me, oh, well, if you do a reverse mortgage, then you leave nothing to your heirs, I show them these numbers have all been reviewed by CPAs and actuaries, and it's the real deal. You actually can leave your heirs far more money if you do a coordinated strategy with your housing wealth and your portfolio assets.
That's a great idea, Janice, and I think that being able to show some numbers and showing them side by side like that helps people to kind of visualize the benefit of using that as a buffer, because we all know that most of us are saving our retirement monies are in the capital markets. They're in the stock and the bond markets. And especially right now when we have a lot of uncertainty going on, if you're planning to retire this year or next year, it could make a big difference about that kind of volatility in your portfolio. So we actually are at the end of our half-hour mark. Does anyone have any questions? You have a chat box there. We can certainly take some questions, and for those of you that need to jump off the call, not a problem. We'll be able to send you the replay link. But if there are some questions, otherwise, Janice has one more slide she would like to share with everyone, and I think it's very critical to this conversation. And at that point, we'll be able to end our call today. So this next one, Janice, you want to explain how this is?
Sure.
A bit of information.
I mentioned earlier that the line of credit on a reverse mortgage grows each year. And I want to illustrate that by showing you year one, we see a line of credit, or at the initial time that the mortgage is taken out, a line of credit of $368,000 and change is available to this person who has a home value of $625,500. At year one, have a look at the column that says line of credit. Their line of credit has grown from $368,000 to $389,000. Let's look and see what is their line of credit after 5 years. After 5 years, let's see if we can get the cursor over. Okay, it's 400 and let me see, is that one, two? Okay, $490,000 after 5 years. And what would it be after 10 years of not having used it? 10 years would be $653,305. So as a person gets older, once they have the line of credit, that line of credit is going to grow every year. If this person never touched their line of credit, by the time they were 99 years old, they would have a line of credit of over $1.7 million. Of course, what would he or she need with it at that point? Let's do something even more realistic. Let's look at 92. If you're 92 and you still haven't used your reverse mortgage and you have a 1.15 million in your line of credit, and what happens if your home went down in value and you've got all of this money available in a line of credit? You have more money available to you than you have equity in your home. You could you could take all of this money and give it to your heirs if you wanted to, and there's nothing that anyone could do about it. But that would really be the exception rather than the rule. Most people utilize their line of credit here and there. Zenobia asked, what are the qualifications? And that's a really good question, because the first qualification is very black and white. You have to be 62 years old, or one of the people in the couple has to be 62 or older. But there are other gray areas with the reverse mortgage, and I'll explain what those are. We don't even assume when we underwrite a reverse mortgage, we do not assume that someone has a very high income. We ask for income documentation. A lot of my clients have only Social Security. And if you have only Social Security and you have a home that you can afford to maintain with only your Social Security, and when I say maintain, I mean taxes, homeowner's insurance, and gas and electric, because we do ask for the square footage of the home, then you will most likely be qualified just based on the fact that you have Social Security income. But what if you only have $700 a month Social Security, and you have a house in, let's say, New Jersey? I used to live in New Jersey, among the highest real estate taxes in the country. Let's say you live in a $200,000 home in New Jersey, but your real estate taxes are $8,000 a year, and that can happen. And let's say you really don't have, maybe you have $700 a month coming in from Social Security, nothing else. You might experience what we call a residual income shortfall. And that means that we've looked at your square footage, we've looked at your gas and electric, we've looked at your taxes and your homeowners. Maybe you even have flood insurance if you're in New Jersey. And we've said, you know, $700 a month is not going to be enough to cover what the monthly expenses are. So what we do in that situation is we'll say, we are going to pay the taxes and insurance for you as long as you have the equity in the home. We are going to pay the taxes and insurance for you so that we know they're getting paid, and we will give you a line of credit. But when we're paying the taxes and insurance, we're holding back some of the money that you might otherwise be eligible to get. If you have a $300,000 house and you're eligible to get $150,000 in a line of credit, we may say to you, well, we're going to take aside this $50,000 to pay for your taxes and insurance for the next X number of years, but you're going to have a line of credit of $100,000. We're not going to charge you any interest on the $50,000 that we're holding back, but once we disperse it to your tax collector, to your insurance company, at that point it will become part of your loan balance at that time. Did that answer your question?
Great. I think so. Lots of interest here. So I know in the interest of time, because we've run a few minutes over, for many of you who do have any additional questions, Janice is available to speak. We can set up another conference call, or I can put you in contact with her directly. We also will be, again, sending out the replay link, so you guys will be able to review all of the slides and dig in a little bit deeper, and for some of you might have come on a little bit later. So I do want to thank everyone for being on the call, and thank you so much, Janice, because obviously this is an area of interest that a lot of people have, especially for many of us. Our home is really not only the place we want to live and stay in, but it's also going to be one of our largest assets. And so being able to leverage that so that we can have a wonderful aging in place lifestyle, I think is something of interest to most people. So with that said, I will end the conversation and the webinar today. I hope that many of you will be on our call next month, where we will dig in a little bit deeper with respect to does money and your personal sensibility, and also any of your concerns around behavioral finance issues around money. Is something getting some kind of fear or something in your background that is not allowing you to kind of wrap your head around taking care of business. So with that said, thanks everyone. We look forward to connecting with you soon. And thanks again, Janice.
My pleasure.
All right. Bye-bye.
Bye-bye.